Hey everybody, it's CryptoBirb, Adrian speaking. Welcome to today's Friday webinar. And today, briefly, because for about half an hour show discussion webinar, we're going to actually get a proper dive, into the market analysis for equities, for traditional markets, for commodities, how it all translates to Bitcoin. We're going to have a look and in detailed analysis of correlation of Bitcoin against S&P 500, how it all kind of like converts, well, basically to Bitcoin dropping today, right? We are going to discuss this and more throughout the show. If you guys are ready, make sure you stay tuned and get ready. We're going to write in a second. Hi, everybody. I hope you guys are doing okay. Today, recording at a slightly different hour and different time. Remotely, not in my office today, but I do really hope that you guys are having an amazing day. We're going to do some, kickoff, I think, very relevantly with what we're seeing basically in the news part, right? So we're looking at a somewhat of a negative reaction of a very positive opening yesterday, throughout the equity markets for Bitcoin, for other cryptos as well. And very promising open, very promising first half of the day actually, went down the toilet right after Jeremy Powell's speech, right? About he's sealing the expectations, just like the Wall Street Journal actually just seals expectations of half-point rate rise in May, right? So we're talking about more aggressive tightening from the Federals, from the Fed side, from Jeremy Powell as chairman. We are looking at somewhat also of some rumors which are not necessarily very promising to equities in the near term, in the short term. It doesn't necessarily mean that the market is going to continue down the path forever, right? We as traders, as investors, tend to have different biases which impact our way of thinking, and rational decisions are not rational anymore, right? There is this representative bias or saliency, if you will, that we, just because the market has been tanking, just because the market has been dropping, we expect it to go down this path forever. And same way, it creates the positive feedback loops, whenever there's this positive market reaction, the market keeps climbing up. And you see the market basically, participants just telling you the market is going to keep up like that forever. None of that really comes real. None of that really comes true. Instead, we're looking at seasonal trends, right? At some seasons that the market performs better, and when the market performs worse. Here we're looking at a rate hike cycle, right? So instead of 0.25 BPS basis points that we saw in mid-March, we're now talking about more aggressive tightening, twice as much aggressive. So the market didn't really absorb it well. The market didn't take it in well. And there are some rumors, of course, or even more aggressive tightening coming up with 0.75 BPS. But whether or not this is going to come, this is another discussion to be had. And I do really want to comment on what's happening in the market, guys. So please let me actually show you and get you straight check on the industrials, right? So we're going to kick off with Dow Jones Industrial Average. Here we're looking at that since the very open, it lost 500 points, down minus 0.45%. Right now at the low 34,000s, right? So here we're looking at a chart which actually compiles a couple of different averages for the short-term average, which actually is represented by this green curve, as much as the medium term and the long term by the 200-day average. So here we are looking at this another rendition of this kind of like a fake out series, right? So we're looking at a very I should say wobbly market, the market that moves in sideways and keeps trapping. You saw a trap there on the bottom, which made people fall into the trap of expecting this head and shoulders pattern to kind of like, just commit the downwards breakout. You more often than not see many traders kind of like when the pattern is forming, and it's not even formed yet. You have the left shoulder, you have the head, and you have the half of the right shoulder. It's not formed, it's not pattern yet ready, it's not complete. And though people keep managing to short early, right, in an early manner, short the right short the right shoulder before it even forms, and as a result, they kind of like get this imbalance on the demand side, on the demand supply side, and the demand usually gets this sort of like liquidity needed to push higher, right? And you get the short squeeze, and as the shorts are covered, it actually, of course, just translates to elevating the price even more, adding to the momentum side. So here you got the failed head and shoulders pattern, followed by a nasty reaction, just like I said, coming off the Powell's speech, right? So, of course, some people would suffer from the hindsight bias, where everything was predictable and easy to predict what Jay Powell would say. But like in all honesty, it is not predictable, right? You never know what they are going to tell you. You never know. And the biggest uncertainty is right at the very even. So here we're looking at a nasty reaction, nasty rejection of another attempt of a breakout above 200-day moving average, which is this red curve, just like I mentioned, and as a result, the failed breakout result. And returning back to these mean levels, to short-term means, short medium-term means, we're looking at in the industrials trading between 34 and 34 500s. And this basically, again, keeps ranging, right? This is not actual trend. You see this chart pattern kind of like develop and continue, not really conclusive so far. And even if we have a look at, the more of the defensive markets, then you're looking at the consumer staples, which are actually seeing even bigger pump right now, right? There's, of course, some local, shooting star candle, if you will, right? Some sort of like a pin bar on top, but followed by this local retracement, around 81 points here. Consumer staples keep pushing higher, of course, as the rate hikes for it's kind of like intensified. You see, you're looking at a healthcare, which is actually losing a little bit today. You're looking at utilities, which are also kind of like, looking a little bit as a potential breakout might be coming to the downside, as long as this short-term moving average at 75 here is going to be broken down. So far, you're looking at still pretty much strong defensive markets performance, which definitely is not very promising, I'd argue, for the risk on assets, right? So that being said as well, let's have a look at my two indices that I watch mostly for equities. Here we're talking about the composite index, the composites, and the S&P 500 as the large caps. So here again, we're looking at this sort of like, potential head and shoulders pattern, but of course it's not complete yet, right? So because it's not complete, it's inverse here with the neckline around like right above 14,500s. It's not complete yet, right? So people may rush to long it into this, and same way that these longs may get squeezed, just the way they did yesterday. And the leverage usually comes off this way, right? So when the market is over leveraged, especially in the short-term time frame, there's too much optimism for some reason, and the market had been looking pretty well before this Jay Powell news kind of like came out of the more aggressive rate hikes in May, change to the game plan. The markets actually closed off lower, not only than they opened, but lower than the local lows were formed at, right? So we're talking about another follow through to the downside so far right now, as the composites trading at very low end of 13,000 points here, searching potentially for some level of support. I'd argue here in this area where the gap, when there was some strong upwards reaction here with the local gap. So I'd argue that if this support doesn't really hold well, we would probably see the mid 12,000s again. And this, of course, is not really the most promising thing to look at, because, it brings more downside danger if the lows at this region coming off the Russian invasion kind of like come broken, right? Same applies to the large caps, but those large caps, as you can tell, are looking a little bit less overextended to the downside. Of course, there was still a very aggressive very aggressive kind of like, just retracement peak to trough so far. But then you're looking at the large caps, which are, also in this, catching up with this negative sort of like a reaction. The large caps opened up yesterday even higher with the gap up, right? So there was a promising kind of like push forward. The expectations were set for continuing higher. And when the news struck, basically you got this ugly, nasty engulfing candle. It's not necessarily the bearish engulfing, because bearish engulfing usually happens at the top, right? So you want to see the bearish engulfing. Just for instance, I'm just searching for it right now. Well, this arguably would be more of a bearish engulfing, or this very candle, usually get this local small candle like a spinning top, and the one that engulfs it, right? It's also called an outside bar pattern, because it kind of like trades outside, opens up higher, and closes even lower, engulfing and absorbing this entire body of a prior candle. So, and this happens usually after an upwards trend. So, and here we're looking, of course, at a downwards. That's why, I would not necessarily put a label on it as the engulfing candle, but still engulfing pattern, but still the candle, kind of like wraps around the entire sequence of the candle bodies before this candle popped in, and the market keeps so far trading at 34, 35, 45, 34, 35, 43, sorry, 45. This is basically at the lower, well, we are crossing the lower end, the lower half of this entire upwards correction, this entire upwards recovery of the lows of the Russian invasion into Ukraine. And the deeper it actually goes, again, the more reluctance you would probably see in going up. So it's definitely, a lot of tumble. The markets are not necessarily looking the best right now to get very, very sharp into it, right? So let's have a quick look in the commodities part, right? So here's another instance of a candlestick pattern formation, if you will, by Steve Nissen. Highly recommended you guys read through the Steve Nissen's works on candlestick analysis, Japanese candlesticks. This is very interesting works, and very, I think, basic position, a foundational position for any candlestick analysis. And those who actually read it through know that we're talking about an abandoned baby or an evening star, kind of like a chart pattern formation, which basically has a quite a strong candle prior to the final reversal, strong candle, followed by a gap up, right? There is this abandoned tiny baby right there hovering, kind of like, like you shoot the baby out over a trampoline, right? And it's kind of like down up there in the air, and then it kind of like falls off, right? So you have this gap up, this baby, which is abandoned because it's not glued to the price action, stands out, deviates strongly, and then you see the come off candle, right? So it's definitely with a little bit of a follow through to the downside, although not close below, so it's not necessarily the strongest. But I would argue that more often than not, this is usually an indication of further downside correction. So it makes sense to keep your eyes open for potential reaction here at the support defined by first of all this descending trend line, right, of this pattern breakout region area previously, and at the same time backed by the 50-day moving average, because this is a daily chart, right? So potentially, of course, this is just some sort of like estimations, just guesstimations, mathematical guesses, if you will, a little bit more. But this is no crystal, ball. Nobody has a crystal ball. I have no idea what is going to come up tomorrow in the charts. I don't know if I wake up tomorrow even. So, all that needs to be definitely approached respectfully, that we do not know much more about future. So, but here is the trend. If we are to trust this pattern, more often than not, you would expectedly kind of like come out down a little bit, retrace on the commodities side. Of course, the commodities have been growing insanely over the course of the past months, with driven mainly by the energy market, by appreciating in value in the price. Oil coming off the Russian kind of like war with Ukraine, as Russia is definitely responsible for big chunk of the oil market. So you see a lot of supply shrink, and when there's a supply shock and the fears of supply shrinking, basically the price tends to elevate upwards. But still, we are talking about a very aggressive trend up, and worst case I see is basically we kind of like close off this rectangle, but more likely than not, I would expect that the price retracement to kind of like stop for the BCOM futures, for Bloomberg Commodity Index futures, to stop kind of like retracing and bounce off the 50-day mean, right? And followed by upwards continuation, like it or not, but the the commodities uh, are very elevated, usually at the end of the financial cycle, and usually 6 to 9 months ahead of inflation, ahead of recession, right? The financial cycle leads the business cycle by about 6 to 9 months on average. That is what we say. There are some deviations to it. And we had the inverted yield curve, as well as the short-term rates were actually returning more, more yields, more percentage than the long-term yields. This is definitely not really promising. And each and every single time we had this inverted yield curve, the recession was bound to come, and it actually came through sometime after, right? So we had very high chances of recession coming in. We have, the peak of we had the peak of the financials for now, right? You see the markets tumbling down. This definitely doesn't work too well in Bitcoin's favor so far, right? I had just recorded an amazing discussion with Julian for the podcast, for the initial podcast, which is coming due this weekend. So keep your eyes open there. And we discussed the on-chain analysis, the fundamental aspects, and how usually Bitcoin should be considered more often than not some sort of like not even a commodity, but a hedge against war, hedge against inflation, just like they would refer to it that this is digital gold more often than not. And instead, we are looking at, ever since 2022 started, on a 7-week basis, correlation coefficient of Bitcoin against equities, the large caps, S&P 500 has been really strong, 0.89, right? Even if we go and take it on the 20-week basis, right? So a bit longer, half a year basis, almost there, you're looking at 0.70, right? So ever since 2022 started, you are looking at a very, very sharp and very aggressive correlation levels, right? This is a very strong positive correlation as 0.89, 0.9, 0.90. See for how long it's been staying there, right? Basically, we're talking about a month and a half of very high elevated readings from the market correlation. And this only tells you that this strong positive correlation tells you that there is alliance, if you will, in the price-wise, in the price charts between equities, between stocks and Bitcoin. Luckily for us, it tends to oscillate, right? So it moves in cycles. It kind of like goes up and down. Incident cycles, it oscillates. So for Bitcoin, whenever equities are going down, it would have been better to be basically on this negative side of the correlation. The Bitcoin is negatively correlated to equities, so that whenever stocks fall off the cliff, Bitcoin climbs up strongly, right? So far, we hadn't seen really something like that. I do hope that something like that actually happens, and that people come to the conclusion that Bitcoin is actually way better hedge from the fundamental factors than equities to recession as well, if you will, right? But of course, there is this I think fundamental change that many people keep missing. Namely, that whenever there's a recession kind of like threats with the rate hikes, and there are some war principles also kind of like just assume there, then these correlations tend to behave differently. The correlations start behaving very unexpectedly. The models start to break down often. Just take an instance of a quick recession of 2020 that we had with COVID pandemic in 2020 March. When the COVID kind of like pandemic started, you saw equities falling off the cliff very sharply. You saw as well, cryptos coming off sharply, and you saw gold coming off sharply. And gold, ideally, is typically kind of like a hedge against these volatility in the equities risk on assets. So whenever the big risks and unpredictable pandemics, asteroids crashing into Earth, like volcanoes, eruptions all over the planet, wars, and all of that charts never tell you about, then the correlations start changing, start shifting, and completely decorrelated markets, those that are not really correlated, start becoming correlated, and gold, equities, Bitcoin, and gold, crypto just go down this way. This is very, very, very awkward and very perhaps unnatural, if you will, but it happens. It does happen, and it also happens for the markets to move in cycles. So that tells me that if we had been staying for such a long time at the very high elevated levels of correlation coefficient for Bitcoin against S&P 500, then this may soon be due to change, right? And if that happens, we would see probably some more relief for Bitcoin traders. Thank you so much for all the kind comments from Vince. Always a treat to have Burb speaking. Much love to you, Vince. There is Lil Odie, there is Karen. Thank you so much, guys, for tuning in, despite of different time. And continuing the next chapters of what I wanted to cover today on the show, on the webinar, is let's give a deeper look in the my favorite time frame, which is 12-hour chart, and the Barbicator Pro, what it tells you my personal trading system. I kind of like got tricked yesterday, to be honest. A very promising close through the current time frame trailer, which is basically the most relevant indicator, one of the, like, to me, the one that I trade based off. And we had this kind of like a bullish mark, which does not necessarily mean it's going to trend up, but you had this bullish environment created. And then, of course, with the bullish close for the first time in weeks, ever since April kicked off, since losing, $45,000 support, we had been looking, of course, Bitcoin tumble and struggle to really come above, $42,000, $43,000. And then we had a successful reclaim at first yesterday in the first half of the day, and followed by a very aggressive sell-off candle closing way lower than several days in a row, coming sharply after Jay Powell's peak. So basically, then we are looking at this signal kind of like getting reverted, right? So I ended up opening a trade after this signal got triggered, and soon later at the end of the day, I closed off for a $30,000 loss. Definitely doesn't happen. I got a thick skin. I actually just elaborated on that within our amazing traders community, which exists since 2017, talking about the Burb Nest. And I got this for elaboration with explanation that this is a trend following systems, one of the trend following systems. And trend following systems, on the contrary to mean reverting systems, which return way higher win rate, 60-70%. On the trend followers, you usually have no more than 50%, right? 30% more often than not is the win rate that you actually get, which means that 70% of the time you're going to see losses, but those losses are cut short. The losses are cut small, right? So that you cut your losses small and short, so that whenever there's this big trend developing, just like you would have the market down, here in November 2021, you saw this system kind of like stay flat entirely for the 4 months ahead until February, then it crossed the signal, right? So usually want to catch, as a trend follower, usually want to catch this long tail. And to catch this long tail, usually you have to kind of like struggle through the noise, get stopped, just like you see this kind of like bullish narratives and bearish narratives flipping back and forth when there is no trend. And when there is no trend, the mean reverting systems work better. But overall, final tip and takeaway for you guys is that over any, it's very hard to generate losses. It's very hard to generate profits, but it's very easy to generate losses, right? We're on this asymmetric side of the deal here, where we kind of like, have to have a thick skin. We cannot be loss averse in those terms that we see losses and we decide this system, this shit. It does apply to crossover, to moving averages. It does apply to MACDs, to RSI, to whatever your trading indicator is. And the discipline, the longevity and application, the disciplined application of a system is what generates the money end of a day. And this trend following breakout system that trades on the breakouts through the current time frame trailer, basically, catches on fire mainly when the trend is up, when the trend is apparent, right? Be it upwards or downwards. And here, just having this kind of like a rejection, we're looking at local follow through to the downside. Of course, equities falling down the floor, are not really promising because of the correlation parts which I commented on. So as long as the stocks continue dropping, Bitcoin would likely not have safe environment for the long traders, who would probably continue moving downwards, sloping slightly, or continue moving in this local sideways. Lots of fake outs. Don't forget that we're kind of like, still not really well reclaimed through the $46,000 region. We saw this $48,000 burst, but then failed to hold the main support at 45, failed to kind of like close above, and there was a resistance, failed to close above the resistance, making it new support. The polarity didn't change efficiently, and as a result, we got this faded movement and further continuation of sideways. The sentiment has been going down the hill as well. Typically, more often than not, the sentiment indicating extreme pessimism on the trader side, on the investor side, usually it does mean that, well, there is some more buying opportunity than selling, historically speaking. The biggest reversals usually come within the time of revulsion, when people are so fed up of losses, that people have lost so much money and so much patience and so much, so much spirit in trading, that they don't wish to even hear about crypto, right? And this kind of like resembles a little bit what we are seeing right now. And real quick, there is this chart that I often use. Let me just display it real quick. This is Fear and Greed Index, of course, and historically, just like you can tell, well, we are talking about the very, very low end of the scale, of the Fear and Greed scale, with the fear being very, very dominant in the market. 26 points on a scale out of 100. Typically, oscillates between 20 and 60, and 20 and 30, making it very aggressive pessimism. And historically speaking, you can tell that most of the reversals in the market, most of the major reversals, 2018 minor sell-off and capitulation, COVID crash, the midsummer reversal last year, and right now we're looking at similar levels of pessimism in the market, right? So this is not, of course, a timing indicator, and it's not going to tell you when to enter a trade, but it does tell you about environment and whether or not the market is considered cheap or expensive. And on the contrary basis, we do know that the markets, the crowds are always wrong at the extremes. They're always right in the middle of trend, which is why you never counter trade very strong trends. But the crowds are always wrong at the extremes, and the more extreme and elevated the fear is, the more the wrong air they are usually. And of course, you at times have to wait months for it before it reverses. It is not apparent or immediate in its effect, but more often than not, it tells that whenever the fear, extreme fear, kicks in, the market is considered cheap, and usually better buying opportunity than it is for selling. Mike Bennett says, thanks for keeping the lights on. Much loves, Mike. Glad you're watching. And finally, before we close off the show, I want to give you guys a couple of comments about the altcoins markets as well. Comparison here with, with several other curves here on this RSI, which is the momentum indicator, the timing indicator, which tells you about the momentum and how it actually develops. Right now, you can see this is a no man's land, somewhere around 40. Well, the extreme levels of 80 or past 20 or below 20 are what you're getting interested in. Here, it's just kind of like a no man's land here. And to comment on the curves, we see the total market cap, excluding Bitcoin, which is basically all altcoins altogether, which is at $1.6 trillion here, with 60 billion on top. And here on the end, on the low end of the chart, we are looking at the orange curve, which represents the Bitcoin's price chart on the left scale, and the DeFi. And the DeFi section, which tells you about $134 billion of market capitalization. And you can compare how these markets kind of like react, right? You can tell that, well, Bitcoin is relatively more flat than, let's say, the DeFi. You can see that whenever there was a positive breakout on the Bitcoin side, the DeFi side kind of like overreacted to it, right? So there is a very apparent overreaction in the positive direction. Whenever Bitcoin pumped, the DeFi pumped, returned even more aggressive returns. Similar, although not as much as for DeFi here, you're looking at a similar reaction with the mainstream altcoins, which is basically this total market cap, right? So DeFi seems to be quite an interesting risk on appetite here curve, which tells you how more deviated it actually becomes, right? When the market failed to hold the main support, just like I said, the freshly broken resistance, which technically should have formed a support out there at 45, 46,000, it actually failed to hold these levels. And when DeFi actually did the breakout, you see there was a very much a follow-through push because of probably lots of fundamental things going on in the DeFi sector, and as well some more optimism that hit the market, you got the very elevated price action when compared with Bitcoin or other altcoins. Is it really trending? I would argue not, right? Instead, you see a lot of sideways kind of like, non-directional movement chop around. You saw a little bit of an upward trend here, but then it actually failed to maintain the momentum. It failed to keep up, and instead you end up looking at these very noisy, chaotic charts. No follow through to the upside, no follow through to the downside. Tells you that no side of the market, no economic side of the market, the demand side or the supply side actually wins. You see them battling back and forth with no real conclusive effort, right? Most likely, we would continue this way, right, until you see a proper breakout. Be it on the Bitcoin past 48,000, be it for the altcoins past 0.23 trillion. Of course, this is just kind of like, doesn't really have too much, I should say, causative effect here, causation. It's rather showing the trends in the hindsight here. Of course, I wouldn't necessarily see or say that just because there's this chart pattern, I would expect the altcoins to continue upwards or something. Definitely not like that. But instead, it tells me how or whether we are in an upwards trend or a downwards trend. Clearly, we are in sideways. No follow through. Momentum is not strong. This definitely doesn't add a lot of consensus to the bullish side of the market. And I would argue that it doesn't necessarily become the most promising environment to get risk on exposure. Finally, guys, before I wrap the show real quick, if you are not members of the Birb Nest, which exists since 2017 as the main community for traders, where we actually get all the best indicators, all the best metrics, all the tools you require and resources you need with 24/7 support from myself, from my team worldwide, regardless of where you are. And if you want to go and actually improve your knowledge in trading, get some tips, suggestions on how to become better traders, we do that since 2017, while 99.9% of other communities similar to this, some people would say, actually evaporated or just disappeared. So I think it speaks for itself. And on top of that, 7 days free. This is what I'm giving to you guys. If you are serious about your trading, come and give it a try. 7 days free. If you don't like it, no need to stay. We're not going to get offended. In fact, it's going to be very clearly beneficial, I think, for everybody to get and come in, get some free resources. If you like it, you'll stay. If you don't like it, feel free to just use it as an opportunity. Free trial, all of that you're getting free. Any charges are not going to be applied. No charges whatsoever. Just an email, first name, and we're going to automatically set you up, guys. Do it. I see you guys in the nest with all your questions. So much love sending from Poland. Hope you guys are staying safe out there. Drop your questions as well in the YouTube side of the things. If you're watching that on YouTube, make sure to subscribe, hit the likes, hit the thumbs up as well, notifications, bells. Leave some comments in the questions in the comments. I'm going to do my best to actually deliver some of the responses to it past the show. That's all, folks. Hope you enjoyed that. God bless you all, and I see you on the next show.